Notes later.
Okay.
Now, if you've just joined us, as we came on air, the Bank of England announced that interest rates are to remain unchanged at 0.5%. They've been like that since March of 2009, so over 2 years they've been at record lows, lowest indeed, since the Bank of England was founded at the end of the 17th century, by a Scotsman, by the way. Though the Bank of Scotland was founded by an Englishman. Happy news for homeowners, bad news for savers. A while back, the Monetary Policy Committee had been expected to lift them this month because of worries over inflation. That's what a lot of people in the city expected, but it seems the latest growth figures have put paid to that. We're joined now by the editor of City AM, Alistair Heath, and by a fund manager, Alpesh Patel. Welcome to you both. Alistair Heath, I think you want to put interest rates up. So, I mean, we've got... People are uncertain yet of the pace or strength of this recovery. Most of the inflation seems to be imported rather than generated at home. And living standards are sure being squeezed for as bad as 80 years ago. Why put rates up?
I mean, for two reasons. These are emergency rates. They're rates of the kind that you put in place when there's depression, when the economy is collapsing. The economy has recovered at least a little bit. The economy is growing a bit, and it's now time to normalise a little bit at least interest rates. And secondly, savers are being trashed. There's just no incentives to save, and I think that's just a mistake. When you want to start to rebalance the economy, you need to encourage savings a little bit more.
So the 0.5%, which, as I said, is the historic low, was an emergency measure. The emergency's over. We might still be in the hospital, but the emergency's over. Time to start nudging them up.
Well, looking at numbers is hardly a good reason to increase interest rates on the basis that this is a low number. It should be done based on growth. It should be done. If you are trying to protect savers, they've got a very good reason to save an uncertain future. They don't need an extra 0.5% to do it. And indeed, the 0.5% increasing borrowing costs for companies will lead to greater unemployment in any event. It'll actually have the exact reverse effect of what the Bank of England wants to do, which it'll raise prices because it increases the cost of mortgages, for instance, and it'll actually cripple growth, which is at an anemic 0.5% in any event.
In fact, the biggest, but I disagree, because I think the biggest reason why growth is weaker than people thought it was is that consumers' living standards are falling at quite a fast rate because of inflation. And the Bank of England's mandate is to keep inflation under control. It doesn't matter why there's inflation. It doesn't matter whether it's imported or not. The point is you've got to keep inflation under control. And they're not doing so, so I think they have to hike interest rates. I'm not asking for a massive increase, just a little psychological increase to say that they still care.
An increase of 25 basis points, quarter of a point interest rate, that wouldn't cripple the economy, would it?
It's not a good reason to do it, that it won't cripple the economy. In actual fact, all it'll do is have no impact in that case, because the markets work on the basis of expectations. You increase it 25 basis points, the market immediately knows that this isn't going to be sustained. It isn't going to be a sustainable increase over time. Therefore, the currency won't appreciate, which is what Andrew's sentence really wants, the minority member, in terms of tightening on the Monetary Policy Committee, because all that will happen is the currency will continue depreciating.
Most of the inflation, as I said, is coming in because of the rise in commodity prices, also originally because of the depreciation of sterling, and now with the rise of oil. Food prices very high globally as well. That looks like continuing for a while. I thought that the purpose of interest rates in dealing with inflation was really to deal with domestic inflation, was to send a signal to companies, pay bargainers and so on, don't ask for too much extra money. There is very little wage inflation. There's very little sign that this imported inflation is producing an increase in domestically generated inflation.
That is true, but ultimately I still think high interest rates would do something about this by increasing the value of sterling, which is part of the point that's just been made. Today the pound fell to a 13-month low because the markets just don't think that interest rates are going to go up anymore. I think that's exaggerated. Interest rates have to start going up because people's living standards are falling too much. I mean, I think it's quite important to start normalising things. People are getting used to very, very low interest rates. A lot of people think that interest rates are going to stay low forever. That's very dangerous.
Simon, where are you on this debate?
I'm a growth man. I really am. I think it's sad that the prime regulatory agency, the Bank of England, is primarily concerned with inflation, not with growth. It should be primarily concerned with growth. Okay. It was a bad decision to hive them off and just don't worry about inflation. There's a huge gamble being taken at the moment. There's no doubt at all that growth is very, very hesitant at the moment.
Fragile.
Very fragile. I thought increasing VAT was crazy. Even now, I mean, I'm paying, 7 times bank rate for my bank loan? I mean, banks are making huge amounts of money on the back of this particular requirement that you simply worry about inflation. We shouldn't. We should be worrying about
so
growth.
you're against putting the rates up for now. All right, gentlemen, we'll leave it there. Thank you for that. We'll keep an eye on this debate, though. It's not going to go away.